Conventional wisdom suggests you should start your retirement with a balanced portfolio, something like 60% stocks and 40% bonds, and then decrease your stock exposure as you age. But more recent research and the data in this video argue this is precisely the opposite of what a retiree should do if they want to minimize the risk of depleting their portfolio. My name is Bryan Mingue, founder of Cardinal Financial, and in this video, I will explain how a retiree may be best served by ratcheting down risk significantly in the early stages of retirement and then increasing stock exposure over the course of their retirement. Reducing stock exposure in your 60s, 70s, and 80s is one of those ideas that sound good on paper but isn't supported by the data. Unfortunately, this is the conventional wisdom and the methodology that major target date funds follow. The general idea is that a retiree should retire with a balanced portfolio, generally around 50 to 60% in stocks, and the remainder in bonds, and then reduce stock exposure over time. Morningstar summarized the asset allocation glide paths of the target date fund universe in their 2025 Target Date Fund Investment Strategy report. As you can see, the average stock allocation is very aggressive, about 90% in stocks, for investors with many years prior to their retirement. But the stock allocation begins to decline meaningfully as an investor approaches 20 years of their target date and averages just under 50% stocks at retirement. The exposure to stocks continues to decline throughout retirement with an average of approximately 40% stocks 10 years beyond retirement and 30% in stocks 20 years beyond retirement. Although this is the conventional wisdom and consistent with rules of thumb like you should hold 100 minus your age in stocks, if your goal is to reduce your risk of running out of money in retirement, this is unlikely to be the optimal strategy. A 2013 paper entitled Reducing Retirement Risk with the Rising Equity Glide Path found that rising equity glide paths in retirement have the potential to actually reduce both the probability of failure and the magnitude of failure for client portfolios. A rising equity glide path would start with a relatively low stock exposure early in retirement and then increase exposure to stocks throughout retirement. This chart summarizes the probability of success results of Monte Carlo simulations based on different starting and ending stock allocations. The starting stock allocation is on the vertical axis and the ending stock allocation is on the horizontal axis. The simulation assumes a 30-year time horizon with a starting 4% withdrawal rate. The highest probability of success, 95.1%, results from a glide path that starts at 30% stocks and ends at 70% stocks. In general, the greatest probability of success results cluster near the glide paths that start around 20 to 40% in stocks and end with 60% or more in stocks, far different than the conventional wisdom. This paper identifies the strength of the rising equity glide path as reducing risk at exactly the point where retirees are most vulnerable to a major market decline. Research from 2007 had already determined that a fixed stock allocation is superior to a declining equity glide path, and this 2013 paper extended the research to consider a rising equity glide path. We can replicate this framework with our own financial planning software and test the retirement plan results for 3 glide paths: the conventional declining equity strategy, a fixed equity allocation strategy, and a rising equity strategy. The conventional declining equity strategy assumes the following asset allocation. The allocation is approximately 50% in stocks at retirement and steadily declines to 44% at age 70, 29% to age 80, and reaches a minimum of 20% at age 86. The fixed equity allocation strategy is very straightforward and assumes a static 60% stock exposure throughout retirement. The rising equity glide path assumes the following asset allocation. The equity allocation is ratcheted down to 40% at retirement and then begins to increase to 50% in the retiree's mid-70s, 60% in their early 80s, and 80% in stocks in their late 80s. These precise equity allocations are not prescriptive, but this exercise is meant to evaluate the merits of a rising equity glide path. The Monte Carlo results will be compared for these glide paths for a sample retiree couple. The retirees are both age 65, have $1.5 million in investable assets, and intend to withdraw an inflation-adjusted $75,000 from their portfolio annually, or between 4 to 5% per year initially. The withdrawal rate over time is assumed to look like the following. Withdrawals start below 5% until the couple's mid-70s, at which point withdrawals increase to 5% and continue to steadily increase. The declining equity glide path strategy yields an 82% probability of success and median ending asset value of $486,000 in today's dollars. The fixed equity allocation strategy of 60% stocks yields an 84% probability of success and $802,000 median ending asset value, again in today's dollars. And lastly, the rising equity glide path yields the highest probability of success at 86% and a median ending asset value of $699,000 in today's dollars. The rising equity glide path results in the highest probability of success when compared to the fixed equity allocation and declining equity glide path, mirroring the results of the chart shared earlier. The median ending asset value of $698,000 for the rising equity glide path is lower than the median ending asset value of the fixed equity allocation strategy. But if a retiree's objective is to reduce the risk of failure or having to change course in retirement, then the probability of success is a better metric to evaluate. Although the rising equity glide path demonstrates value in the previous scenario, where withdrawals were assumed to be relatively similar each year, the strategy may be even more impactful in scenarios where retirees have much higher withdrawal expectations early on in retirement. For example, a couple may rely more on their investments early on in retirement due to a combination of factors. Common factors that lead to a higher reliance upon investments include retiring before Medicare age and assuming higher medical costs before age 65, delaying Social Security to take advantage of the 8% annual benefit increase, or planning for a bigger travel budget for the first several years of retirement. The following withdrawal rate example assumes delaying Social Security until age 70 and an extra $20,000 travel budget for the first decade of retirement. As you can see, the withdrawal rates are assumed to be in the double digits until the retirees begin receiving Social Security, and then the withdrawal rate drops again after their travel assumption declines. In these scenarios, retirees are even more exposed to the sequence of returns risk, or an adverse market environment in the early years of retirement. A significant market decline plus significant withdrawals from the portfolio could permanently impair a portfolio and make it impossible to recover. Reducing risk through an approach like the rising equity glide path strategy could be even more valuable in these scenarios, while the declining equity glide path would subject your portfolio to the greatest market risk exactly when you can't afford it. While there is a lot I like about target date funds, the conventional approach to reducing stock exposure throughout retirement is not supported by the data. A counterintuitive approach to your retirement allocation, like the rising equity glide path, could meaningfully enhance your retirement plan's outlook, increasing your ability to spend in retirement and reducing the risk of having to make an abrupt change. Thanks so much for watching this video. If you'd like to learn more about Cardinal Financial or the ideas in this video, please check out the links in the description.